Taher Badshah, CIO of Equities at Invesco Mutual Fund, is joining us right now on the show. Taher, thanks very much for taking out the time. Let's get a sense of what you believe the markets are likely to do, and whether or not the negative noise that we're getting with regards to macro indicators, global uncertainty that we're facing right now. Though the equity markets are doing absolutely fine for themselves, but just the trade tensions, Brexit, everything else that's possibly the reason why you could see some bit of turbulent moves. What's the gauge, and what's the investment idea and strategy now?
So, well, I would think, basically, I think, obviously, as we know, markets are forward-looking, and, at some level, it is also about expectations versus reality. And I think in the last 6-8 months, we've been having quite a tough atmosphere in terms of many issues, either globally as well as especially with respect to the domestic market, particularly with regard to the banking and financial services space. And I think incrementally, if we look at it from where we were, let's say in October, November last year to now, and some of the big fears and anxieties which were there in the market, I think one by one, gradually things seem to be receding. Not to say that everything is hunky-dory and every problem has been solved, but I think the expectation that the NBFC crisis would probably become a lot worse, and the domino effects and the collateral damages would be substantially higher, I think that has not necessarily played out. I think some of the issues with regard to some of the entities which were in stress is gradually getting resolved as they are able to kind of raise, coming closer, if at all, to raising money. So system seems to be settling down. We also probably had a situation where government response was not as strong. I think this time around, in the last few months, we've seen reasonably better action out of the government. Not that there are a lot of big bang reforms, but I think quite a number of policy measures seem to look like they're all constructive, they're all well-intentioned, they should add up to something. Of course, there is the corporate tax cut, which in the meanwhile supports earnings. So I think we're kind of getting out of the very tough groove that we were in a few quarters ago. It's still going to be a arduous journey, but I think market, like as I said, is banking on incremental. And last but not the least, I think the global liquidity situation and the domestic liquidity situation will continue to kind of drive markets, at least in the near term.
Taher, do you expect 2020 as a year to be much better than what we've gone through in 2019? But the period from September 2018 to September 2019 has been a really rough ride for the equity markets. Pain points across the board, not just the banking system. Now, though, you could expect a little bit of recovery for some of these bigger banks, and that could spur some more interest back into them. But as a year, 2020, do you think we turn a new page?
I would think so. I think quite a number of some of the measures which have been taken in the recent past will kind of play out gradually. I wouldn't use the term much better, but I think it will probably be a better year compared to 2019. We will obviously see base effect. We will see, liquidity in the system kind of helping growth come back. I think NBFCs, after a very sharp 30-35% contraction, should kind of settle down. We'll obviously see a differentiation between NBFCs and NBFCs, but I think the system will probably revert back to some normalcy of growth. And at one level, NBFCs do, I mean, if they get the liquidity and they are able to borrow in the market, I think they will drive demand. So in case of NBFC related growth, supply creates its own demand, and I think some part of the demand erosion that we saw in the 2019 year was to do with the supply impact at the NBFC level. So yes, I would, in totality, I would probably think that it's a bit of a risk-on market from a global standpoint, as well as from a domestic perspective. We should see things settling down. Consumer sentiment can probably get better, and we're kind of hoping that we will see some bit of spark out of the rural markets, as well as food inflation becomes a little more beneficial to rural incomes, and government spending in the rural areas becomes a lot more supportive.
Taher, I just want to get your view on how a few months ago, we actually saw a period of peak polarization where the weightage of the top Nifty 50 stocks hit highs of about 64% versus the bottom 35 stocks. Now that historically has been a turning point where, you in the rally that follows this period of peak polarization, you have the bottom 35 stocks starting to move up and a backseat being taken by the top 10 drivers. We've started to see that happening. So from the peak weightage of 64%, it's come down to about 62% already. Do you see that, probably unfolding in a more larger fashion, where you see a bigger impact from the bottom 35 stocks?
Yes, absolutely. I think it's all a function of where we are in the overall growth cycle. And I think if the overall economic growth cycle were to become a little more broad-based, and which is what I would probably think will likely happen in 2020, I think it's a fair game that, the markets will broaden. Why should investors just chase 10% stocks, 10% growth stocks at 50, 60 multiples if there are opportunities wherein you can probably see either similar growth or probably slightly better growth, maybe at half or 1/4 of the multiples. So it's going to be a rebalancing for sure at some level, as we see, and it's happened in the past. It's not that it is something which has not happened. We've seen it as late as 2 years back when there was a substantial rally in mid and small caps, and at that time large caps valuations were not as high. So I think that mean reversion is more or less a given, and I think the right triggers would obviously be the recovery in the growth cycle. So yes, this will start coming down. As you rightly said, we're already starting to see that. So probably if I were to look at data on the last 1 year basis, there is still a large difference between the large cap and mid small cap performance. But I think when we zoom it down to the last 3 months, we see probably parity within performance of large, mids and small. So I think it's starting to happen. It's in the early stages, but it should probably unfold a lot more further in the course of 2020.
Watch out, Bajaj Finance is down about 2.5%. Is the second worst performer on the Nifty 50 today. We're talking about the heroes of the last rally just starting to take a bit of a pullback from 4250 or thereabouts. This one is now at 3982 despite a very successful QIP. Just some money getting rotated. Taher, good morning. Neeraj here. Taher, the tide seems to be turning for some specific pockets in a meaningful way, and can't not discuss telecom here. What is your view, Taher? Do you think that after the news is out of the bag, but maybe some of the impact still to be felt for the next few quarters, fundamentally, is there merit in trying to own any of the telcos?
Well, so as far as the telcos go, I think we've been backing the story now for probably about maybe 2-3 quarters, and I think for us the premise was obviously this, that beyond a particular point pricing was becoming unsustainable, and there would be a certain amount of expectation of returns for most telcos on their investments, and conditions were getting ripe for that. But obviously, we didn't know as to how it would manifest itself and how it would play out and with what intensity. So I think what is currently happening is not exactly out of line of our expectations when we started to look at these names. They have done a fair bit in the recent past, and they are responding to some of the recent announcements and the changes to the pricing structure. I think obviously there is room for price increases to happen further as well. But it's a fairly large quantum immediately. We need to see at the ground level how customer response is, and what eventually is the kind of benefits which accompany some of these price increases. So we'll from here on, I think it is important to allow the system to stabilize and see what the net impact is. These are ultimately not businesses which will not have any capital intensity. Somewhere down the line, spectrum related investments, etc., will probably once again come back into play, maybe not immediately, perhaps 4 to 6 quarters down the line. So one has to brace for that as well. But yes, it does give a lot of comfort to many of these telcos to come out of the hole, improve their balance sheets, and markets have responded a fair bit to some of these developments as well.
Taher, the other question is on PSUs or the divestment theme, and I want to understand what a large CIO of a large mutual fund managing public money would do. I've spoken to a number of private investors who are saying that they would tactically allocate some capital to divestment, citing what happened in 2004 when Arun Shourie announced that disinvestment plan, and now we have a firm disinvestment plan in place. Is there merit in putting money to work in the government-owned entities?
Well, there is merit in putting money to work irrespective. I mean, provided you create a decent quality portfolio out of the PSU basket. So it is just like as it works in the private sector space. I mean, even within the PSU, you have to be selective about the kind of companies that you build into your portfolio. As you know, we run one of the perhaps the only two PSU funds which are available in the market today, and we've managed to run this portfolio reasonably successfully over the last many years. So to that extent, I think, and it's a large part of it is due to the way the portfolio has been structured and the stock selection has happened. So we can't take away that from the equation, despite the fact that, yes, I would agree that there is merit at this stage, given the fact that, there are 2-3 things that work for PSUs. Obviously, the fact that government, plans around strategic disinvestment, etc., should probably help some bit of re-rating in PSUs. It gives you a chance to probably participate in many of the core sectors in the economy. And like as I said, if you're probably looking at possible economic revival in the next couple of years, then clearly many of the PSU businesses would stand to benefit out of that. And more recently, I think we've seen quite a number of new, unique businesses emerge through IPOs, etc., in the PSU space, which provide for an opportunity to own some of these. And many of them do tend to be monopolies, virtual monopolies or duopolies in many of their businesses. So I think we can't take away the fact that stock-specific stock selection is of vital importance as far as the running of the PSU is concerned. But I think if you get that equation right, they can at least give you a 10% kind of earnings growth in the base case. So without re-rating as well, I think early double-digit return is possible, and that is probably something that we've kind of been able to deliver in the recent past.
Bharti Airtel is now up about 7.5%, with Z being up in the session by 3.5%, and Reliance too up about 3.5%. Taher, one last word from you with regards to any portfolio rebalancing in terms of sector weighted changes that you would recommend.
Like as I said, I mean, we have, and we've been saying this for now some time, so it's not something that I'm, saying something new which I'm saying. But yes, I mean, we've had this preference for mid and small caps for a fairly decent period now, for the last almost a year. Not that it has necessarily worked out for us as much, but I think it is beginning to work, and we are continuing to kind of see value in some of these, in many of these cases, and we are happy to kind of bite into them. I can only say that 75-80% of our incremental ideation of out of our teams in the last 1 year has come out of mid and small cap. So it just tells you where the comfort lies as far as even ideas out of our analyst desks is concerned. So that is one. But from a sector perspective, I don't really think we have. I still have a case where there is a few sectors which significantly appeal to us. We have individual opportunities across several sectors which are exciting. So I wouldn't exclude either defensives or the FMCGs or any of that in order to only prefer some of the beta names or the ones which are linked to probably the industrial or growth cycle. But we have a balanced approach to these kind of things with regard to our portfolio conduct, and I think we will continue on that balance. But we are seeing a lot more individual opportunities across different kinds of sectors, bottom up, so to speak, and that's the way to go.
Okay. Taher, thanks very much for joining us. Really appreciate your time this morning.
Pleasure. Thanks very much.